Okay, class. Good evening. So today we are starting another topic, and the topic is IFRS 16 on leases. IFRS 16 on leases. So the first thing we need to look at in this standard is to have an understanding of what a lease is first. That's the first thing we're going to look at, what a lease is. And this standard said that it said a lease is a contract or part of a contract that conveys the right to use an asset for a period in exchange for consideration. So when we talk about lease, the first thing we need to look out for is that there has to be a contract, because a lease is a contract first. And you have learned in IFRS 15 under revenue, in IFRS 9 and IAS 32 under financial instruments, you already know what the contract is, because those standards too, they are also a contract. A contract must exist before they can occur. And our back and forth on what a contract is, we generally agree that it is an agreement that has legal consequence, an agreement that has that is enforceable by law, that has enforceable rights and obligation. That is a lease. So again, today, lease, there must be a contract. And also, a lease can just be part of a contract, meaning you can have a contract that deals with other items beyond just leases. That lease is just part of it. it can be part of a contract. And this contract must convey the right to use an asset, which they call the underlying asset, for a period in exchange for a consideration. So, right to use an asset. That means there has to be a party who owns the assets, that has the legal ownership of the asset. And that person that owns the asset is ready to give up the asset, is ready to convey or transfer the right to use the asset to another party. Of course, it won't be forever. It's for a period. It's for a period. It could be 3 years, it could be 4 years, it could be 5 years, it could be 10 years, it could be 20 years. It will end. And it is in exchange for consideration. Of course, you will pay the person. The owner will get paid. Now, these two parties in a lease agreement are usually the lessor and the lessee. The lessor is the owner of the asset. That is the guy that conveys the right to use the asset to another party, and that other party is the lessee. The lessee is now the tenant, or the person that now has the right to use the asset. Today, what IFRS 16 will teach you is how will the lessee and the lessor account for these transactions in their respective books of account. That is what I hope to cover today. And you will see, particularly for the lessee, who is the tenant, you would see the way he would treat this transaction and the way he will present this asset. You see that it's going to comply with the conceptual definition of asset and liability rather than legal form. You would see. And the treatment of leases in the books of the lessee will specifically make us understand that a lessee, who is the tenant, usually would have loved to even buy this asset outrightly, but because of limited resources at his disposal, he believes it's better for him to enter into a lease arrangement. Because a lease arrangement will give him that leverage to use an asset without having to drop so much money. It gives him the opportunity to pay for that asset over so many years. It gives him that leverage. So in actual sense, he actually needs an asset that he wants to use in his business to generate economic benefit. But now he has the opportunity to do that without laying so much capital outflow. When we get to the accounting treatment, you will see what we're talking about. Now, let's go straight to it. The first key thing in accounting for leases is your ability to identify whether a lease exists in a contract. When you pick up a contract, you need to be able to identify whether a contract contains a lease. And the way you will know that is if the contract contains something we call right to control an identified asset. Right to control. If a contract contains right to control in such a way that a party that is a tenant, a party that is not the owner of an asset, if he has right to control that asset, if he has right to control the use of that asset, there is a lease. There is a lease. That is typically what he leases. And when we say right to control, it means two things. Number one, it means the right to obtain substantially all the economic benefits from the use of the identified asset. Number two is right to direct the use of the asset. Right to control firstly shows that the lessee or the person who is not the owner of the asset has right to obtain substantially all the economic benefit from the use of the asset. What this means is that he is the only one that is using the asset. Because for somebody to have substantially the right to obtain all the economic benefit from the use of an asset, that means there is nobody using it. It's just him alone that is using it. That is one indicator of right to control when he's the only one using it, or to put it more technically, when he has right to obtain substantially all the economic benefit from the use of the asset. Number two is right to direct the use of the asset in such a way that it's the one that is making the decision on what he wants to use the asset to do. No other person is directing him. He has in mind what he wants to do with the asset without restrictions. That is right to direct the use. When an individual or a party that is not the owner of an asset has the ability or rights, or these two rights I've mentioned, that is right of control. And that signifies that there is a lease in this contract. Also, when these two are present, there is the lessee that is only using the asset in such a way that he obtains substantially all the economic benefits, or is the one that has right to direct the use of the asset. It simply means that that asset is not something that can be substituted by the lessor, meaning that the lessor cannot come and say that this asset that I've leased to you, can I have it for 2 days? Or can I use it for 3 days? Can I use it for 1 day? No, it's not going to happen. It cannot be substituted. It cannot be substituted. That goes to show that before we can say that there is right of control, before we can say that these two rights exist, it means that we need to be able to pinpoint down a specific asset. There must be a specified asset. And it has to be a singular asset or more, depending on the number of assets they have agreed in the contract. But we must have this specific asset that this person is using, because that is the only way we can know that, okay, he is obtaining substantially all the economic benefits, or is directing the use. If there is no specific asset, we can't do that. And the lessor cannot come at any point in time and say he wants to substitute. He wants to change the assets. No. No. If that happens, then there is no right of control and there is no lease. That is how to identify whether there is a lease in a contract or not. I will solve 3 questions just to strengthen your understanding on identifying a lease in a contract. Number 1, it says BDO Transport Company entered into a 3-year contract with CML, under which CML supplies BDO with 5 luxurious buses for the purposes of interstate transport. CML owns the entire 5 buses specified in the contract. BDO determines the route taken for the interstate transport as well as the pricing. BDO can choose to use the buses for purposes other than the interstate transport. When the buses are not being used, they are kept at the premises of BDO and cannot be retrieved by CML unless BDO default on payment. If the buses need to be serviced or repaired, CML is obliged to provide a temporary replacement of the same type of buses required. Determine whether the above contract is a lease contract. Okay, good question. Now, the lessee here, or the tenant here, is BDO. Because they told us that under this contract, CML supplies BDO with 5 luxurious buses. And of course, the first thing I'm noting here is that there is a specified asset. The asset is specified. They told us 5 luxurious buses. Fine. Now, let me now check if these two are met. Let me check whether BDO has right to obtain substantially all the economic benefit and also right to direct the use. Let's look at it. We're told that BDO wants to use these buses for interstate transport. Of course, CML owns it. Now, the first thing here is that they say BDO determines the route taken for the interstate transport, as well as the pricing. I mean, what that is showing me is that BDO has right to direct the use. He's directing the use. Another one is that they told us that BDO can choose to use the buses for purposes other than the interstate transport. This further strengthens our position on right to direct the use. It shows that BDO has right to direct. It's taking decision on how he wants to use the asset. We're also told that when the buses are not being used, they are kept in the premises of BDO and cannot be retrieved by CML unless BDO defaults on payments. What that is showing me is that it's only BDO that is using this asset, because CML cannot retrieve it for whatsoever unless BDO defaults on payment. That goes to show that BDO obtains substantially all the economic benefit because he's the only one using the asset. They now said if the buses need to be serviced or repaired, CML is obliged to provide a temporary replacement of the same type of buses. That's okay. I mean, they were very clear that if there is need for service or repair, you can take it. They can take it. Of course, they will bring it back. Following from this analysis, it shows clearly that there is a lease in this contract because BDO, who is not the owner of the asset, has right to control because of all the indicators we have seen that shows that he obtains substantially all the economic benefits and he also has right to direct the use. You see, all of these I've explained is in your solution, is in the note I've given to you already. Another question. This one says that BDO Transport Limited has recently made substantial cuts to its interstate transport service. It will now provide such services only in cases of great need. It has entered into a 2-year contract with CML for the use of one of its luxurious buses for the interstate transport. The luxurious bus must seat 45 people, but CML can use any of its 45-seater luxurious buses when required. The luxurious buses are held on CML premises and are only made available to BDO on request. Required. Determine whether the above contract is a lease contract. From this question, you will see that they told us that BDO recently made substantial cuts to its interstate transport service. It will now provide such services only on great need, okay? So it has entered into a 2-year contract with CML for the use of one of its luxurious buses for its interstate transport. You see, the first thing I'm noting here is this. BDO entered into a contract with CML for the use of one of its luxurious buses. This shows clearly that we don't have a specified asset. There is no specified asset. And that is a serious issue. When we cannot pinpoint to a particular asset we are leasing, whether single or multiple assets, is a problem. It is a huge problem because that shows clearly that there is high likelihood that this is not a lease. But let's read on. One of its luxurious buses, no specified asset. We're told again that the luxurious bus must seat 45 people, but CML can use any of its 45-seater luxurious bus when required. The second sentence also shows that BDO does not obtain substantially all the economic benefit from this asset because CML is also using it. It says CML can use any of its 45-seater luxurious bus. That already disqualifies it. It must be BDO that should be the sole user. But now CML can use it. Going forward, we were told that the luxurious buses are held on CML premises and are only made available to BDO on request. Well, this doesn't really affect right to control. The buses can be in the premises of CML. It doesn't matter. It doesn't mean CML is using it. I mean, what is important is who is using it. Whose premises it is not important. What is important is who is using it. And from this paragraph or this sentence, they already told us that CML2, who is the lessor, can also use the 45-seater buses. That greatly shows that there is no lease in this contract. The solution is here for you. Next, he said, WASPA enters into a 10-year contract with a telecom company for the right to use 3 specified physically dark fibers within a large fiber optic cable connecting Osun to Ibadan. WASPA makes the decision about the use of the fibers by connecting each end of the fibers to its electronic equipment. WASPA powers the fiber and decides what data and how much data those fibers will transport. Determine whether the above contract is a lease contract. So WASPA is the lessee and he has leased a physically dark fiber within a large fiber optic cable connecting Osun to Ibadan. That means they have already specified the asset. There's a specified asset. We're told that WASPA makes decision about the use of the fibers by connecting each end of the fiber to its electronic equipment and the state other uses. That also shows clearly that WASPA is directing the use. And there is nothing to indicate further that this telecom company is also using these same assets. There's nothing here. So you can conclude that there is a lease in this contract because WASPA has right to direct the use and there's an identified asset. Remember, I told you that a lease is a contract or part of a contract. I want to show you a scenario where a lease is just part of a contract. That is what we call multiple components, where a contract deals with a lot more beyond just lease. It deals with other items beyond just lease. So let's look at this question. Let's look at this question together. It says that under a 4-year agreement, a car seat wholesaler, car seat, buys its seats from a manufacturer. Under the terms of the agreement, the car seat licenses its know-how to manufacture royalty-free to allow it to construct a machine to manufacture the car seats to car seat specifications. Ownership of the know-how remains with car seats, and the machine has an economic life of 4 years. So car seat pays an amount per car seat produced by manufacturer. However, the agreement states that a minimum payment will be guaranteed each year to allow manufacturer to recover the cost of its investment in the machinery. The agreement states that the machinery cannot be used to make seats for other customers of manufacturer, and the car seat can purchase the machinery at any time at the price equivalent to the minimum guaranteed payment not yet paid. Required. Is there a lease in this arrangement? Let's so let's read it again. It says, under a 4-year agreement, a car seat wholesaler car seats buy its seats from a manufacturer Okay. What this sentence is telling me is that there is an agreement between a buyer and a seller. So if I want to judge by this first sentence, there is nothing like lease here. It's just a car seat wholesaler buying seat from a manufacturer. So let's see what the second paragraph is saying. It says that under the term of the agreement, it says car seats licenses its know-how to manufacture royalty-free to allow it to construct a machine capable of manufacturing the car seat to car seat specification. Ownership of the know-how remains with car seat, and the machine has an economic life of 4 years. What the second paragraph is telling me is this. The car seat wants those seats to be manufactured in a certain way. Probably is not satisfied with how manufacturer is manufacturing it. So he says that he knows how to do that. He said he licenses its know-how to manufacture royalty-free. That so that manufacturer can construct a machine that is capable of manufacturing car seats to car seat specification. Ownership of the know-how remains with car seats, and the machine has an economic life of 4 years. So what is happening here is this. Manufacturer is going to manufacture a new machine, so that the seats you will be producing or manufacturing going forward would match exactly the way this other guy wants it, this car seats, the way he wants it. I mean, he is the owner of the know-how. He is the one that came up with how the machine should be manufactured. Of course, the know-how is his own, but now a machine has been created that has a life of 4 years. So what is coming out from this paragraph is the fact that there is now a machine that has 4 years. That's a tangible item we can take out from this paragraph. There is now a machine that has 4 years. Of course, if I may ask you, who is going to be the owner of this machine? Is it car seat or manufacturer? Who do you think should be the owner of this machine? Is it car seat? Manufacturer, that's correct. Manufacturer is the owner of the machine. He's the one that manufactured the machine. Now, the next paragraph, it says car seat pays an amount per car seat produced by manufacturer. However, its agreement states that a minimum payment will be guaranteed each year to allow manufacturer to recover the cost of his investment in the machinery. So for every car seat that this guy buys, he pays an amount. Of course, he has to pay. But they now say that the agreement says that a minimum payment will be guaranteed each year to allow manufacturer to recover the cost he has invested in that machinery. So on top of the amount, or inside of the amount agreed, the manufacturer, that car seat pays for that car seat, they have added a minimum amount just to ensure that this guy recovers his investment from that machine. So that means car seat cannot even buy those car seats from any other place. It won't work away since he has already guaranteed manufacturer of a minimum amount. So he will always patronize manufacturer just so that he can recover his investment on that machinery. Now, the last paragraph. The agreement says that the machinery cannot be used to make seat for other customers of manufacturer, and a car seat can purchase the machinery at any time at a price equivalent to the minimum payment not yet paid. Now, they are now concentrating on the machinery now that has been created. That machinery cannot be used to make seats to other customer of manufacturer, and that car seat can purchase the machinery from manufacturer at any time. So is there a lease in this agreement? Yes, there is a lease. Yes, there is a lease, and the lease is relating to that machinery. This is as good as, that was why I asked you that who owns that machinery? Somebody said manufacturer, that's correct. But the second question is, who has right of control of that machinery? It's car seats. As you can see here, manufacturer cannot use that machinery for any other customer, only for car seats. That shows clearly that car seats has right to obtain substantially all the economic benefits from the use of these assets. He has right to obtain substantially all the economic benefits. And of course, he has right to direct the use because he's even the one that gave them the know-how on how they should manufacture this machine. So he has right to direct the use. So he has right to control. So there is a lease in this contract. Just that this contract, leases is just part of it. There is another part of it that is a normal purchase arrangement. There's a non-lease component of it, which is a normal purchase arrangement that car seat buys seat from manufacturer. That's a normal purchase arrangement, or which is the non-lease component, and there's a lease component there as well. Okay. Leases is always for a period. That period, we call it lease term. This period is usually non-cancelable. We don't expect to be cancelled, even though it can, but it's assumed for the purpose of accounting for this, it's a non-cancelable period for which the lessee has right to use an underlying asset. However, this period can be extended. This period can be extended if the lessee is reasonably certain to exercise that option. And when will he be reasonably certain to exercise? Of course, if it is favorable to him to extend. I mean, there is a lease arrangement that will cover 4 years, but they say you can extend it for another 2 years. So if it is favorable for him to extend, then he will extend. If it's favorable. This lease term can also be covered by an option to terminate if the lessee is reasonably certain not to exercise. Of course, every contract will have a termination clause. So usually we'll just ignore and that will not really affect how we account for this, because we don't expect termination. We don't expect termination, but if it happens, fine, everything stops there. But we expect that the lessee should be reasonably certain that he won't exercise the option to terminate. So if you look at this question, they said the lease contract is for 5 years. The lease payment is 10,000 per annum. The lease contract contains a clause which allows the lessee to extend for a further 3 years for a lease payment of 5 naira per annum, as it is unlikely that the lessor would be able to lease the asset to another party. The economic life of the asset is estimated to be approximately 8 years. What is the lease term? The lease term here is 8 years. Though the original non-cancelable period is 5 years, but they said they can extend by an additional 3 years, and he will pay only 5 naira. Somebody that was paying 10,000, they now say, okay, during the extended period, you pay 5 naira. Of course, he will exercise that option. Since it is favorable for him to exercise, that means the lease term is 8 years. Okay. Now, how do we account for this? This is where we want to be. Tonight, we are going to look at how the lessee accounts for lease arrangements, and we are also going to look at how the lessor account for a lease arrangement. It's very straightforward, extremely straightforward. So let's start with the lessee, who is the tenant or the person that has right to use the asset. So for the lessee, at the commencement date, which is the date they started the lease is agreed to commence. The lessee is going to recognize 2 accounts, a lease liability account and a right of use account, and a right of use asset account. Of course, since this is a liability, it's as good as it's going to credit this. It's crediting this, credits, and is debiting this. That's what the lessee is doing. It's crediting the lease liability and is debiting the right of use asset. Then the second question is how much? What value? How will he measure it? It says the lease liability. Let's take the lease liability first. It said is measured at the present value of lease payment not paid at the commencement date. It is measured at the present value of lease payment not paid at the commencement date. The way you should see that is this. If we lease an asset, and you're supposed to pay 10,000 naira per annum for 5 years, So at commencement date, you are saying you should debit that asset, which you call right of use asset, since you are the one that has right to use it, since you are the only one that has right of control. Conceptual framework will say is your asset, put it in your books. So you debit right of use asset, but we call it right of use asset just for us to know that it is a leased asset. You credit lease liability just to show that you have a liability. Now, in this wise, the liability you have, at a simplistic level, at the commencement date, you'll agree with me that is 50,000. If he hasn't paid anything, it's 50,000. Because he's going to pay 10,000 naira per annum for 5 years. However, in reporting, we do not recognize future value. We always account for time value of money. So we need to discount that future amount to present value. So we cannot say that he's owing 50,000 naira because those amounts are paid in the future. They are paid in the future. And we do not recognize future value in our books in reporting. So we need to discount it to present value. And anything that has to do with discounting annual payments, we will use annuity to discount it. I will show you when I get to the workings. So what I'm trying to tell you in essence is that this guy is saying that lease liability is initially measured at the present value of lease payments not paid at the commencement date is absolutely right. And it makes sense because that is how much you are owed. But we need to get the present value. We do not recognize future value. If you remember, when I was teaching you, is this step 3? Yeah. Under IFRS 15, transaction price. I even told you that transaction price can be affected by time value of money. When you sell goods to somebody and the person will not pay you until much later into the future, usually you consider time value of money. That was the value today. And that's what's happening here for this lease liability. What we recognize as liability today is the present value of those rents you will pay. That is why they said present value of lease payment not paid. Because there is likelihood that he might have paid a deposit. They might say, okay, pay the 10,000 naira now. Pay 10,000 naira immediately. So that means he's remaining 10,000 for 4 periods, like around 40K. Just that we will not recognize the entire 40K. We will not recognize 40K just like that. We will need to get what's the present value of the 10,000 naira per annum for the next 4 or 5 years. Present value of lease payment not paid. Now, that being said, you see, these 10,000 on lease payments, which constitutes the liability in question, sometimes this payment could be a fixed payment, which is usually the case. Fixed, it will be fixed. You know how much you are paying for the next 4, 5, 10 years. Of course, there could be some variable components there in such a way that they will have said, okay, after 2 years, so we will increase, or after 3 years, so we would review. If that is specified, then that would affect our calculations of lease liability. And also, there's something we call residual value guarantee. That will have also affected our lease payments. Residual value guarantee. Everybody in this class knows what a residual value is, which is the value of an asset at the end of its useful life, or the scrap value of an asset. So when they say that residual value is guaranteed, it goes to show that somebody is guaranteeing another party that you will get a residual value, that this asset would have a residual value. And of course, in this type of arrangement, it will be the lessee making those promises. It will be the lessee making those promises. It's just promising the lessor that he's not going to misuse the asset. He's going to use the asset in such a way that at least you will still be able to sell it and get something. And that's what we mean by residual value guarantee. Usually the lessor will not believe the lessee. And right from day one, they will have included this residual value guarantee. They will have included it as part of the lease rental. That's okay, since you are sure you are guaranteeing me, let's include it. Be paying it from now. Let's spread it over the lease term. Also, you can also include purchase option, which is where the lessee has the option to buy the assets at the end of the lease term at a price which we call purchase option. So usually when they have that kind of arrangement, they will have also included that amount as part of the lease rentals. They will have included it. Now, you see, at the end of the year, which is the lease liability is subsequently measured. When I say that, it means at the end of the year, we're going to increase the lease liability by interest, and we're going to reduce it by the lease payments. Of course, reducing it by the lease payments is clear. I don't think that requires any further breakdown, because at the end of each year or at the beginning of each year, the lessee will be paying the rent small every year. So that rent, you just be using it to reduce your liability. You'll be using it to reduce your liability as the lessee is paying it. That's that lease payment. It reduces your liability. So who can tell me the double entry for these lease payments? I need you to tell me the double entry for these lease payments that is reducing our liability.
Let me try. I feel you debit your liability and credit cash since you're making the payments.
That's absolutely correct. You debit liability and you credit cash. That's correct. Also, they said you're going to increase by interest the lease liability. So you increase the lease liability with interest. Again, why is interest coming in here? Why are we increasing the lease liability with interest? Can anybody try? Why are we increasing this lease liability with interest? See, number one is time value of money. Okay. anytime we do discounting in reporting, anytime we do discounting, like what we did here, that we did present value, anytime you meet anything like that in reporting, as you move through time, in fact, at the end of each year, you are going to be adding interest through finance costs to that item. You are going to be adding interest. So all you're doing is you are unwinding the discount as you move through time. Since you have discounted the present value, then as you move through time, you need to find a way to move and increase back the amount. So that is why this finance cost is like you're going to debit P&L and you're going to credit the lease liability every year. That's what this item is doing here. And that is how we account for lease liability. Now, the right of use assets, of course, this is the assets that we leased. It's going to be measured at costs. And this cost is going to be the amount of the initial measurement of the initial liability. This should make sense to you. That is the present value of lease payment not paid at the commencement date. Don't forget, this liability, we say you credit liability, you debit right of use asset. So the same amount with which you debited or credit liability initially, which is the present value of lease payment not paid at the commencement date, is the same amount that you use to debit your right of use assets initially, which is the present value of lease payment not paid. Debit, credit. So, but the right of use asset is collecting a debit. The second item is the payment made at or before the commencement date. This is common in a lease arrangement. They will always ask you to drop a deposit. So these deposits, since you are paying, you're going to credit bank and you're going to debit the right of use assets. Credit bank, debit right of use asset with the payments made at the commencement date. So this should make sense to you because this first one is representing what you have not paid. This second one is representing what you have paid. What you have not paid plus what you have paid is the total value of the asset. Yes, that's the total value of the asset. What you have paid and what you have not paid. That's the total value. And that's what right of use asset is. How much have you agreed to pay in total? That's the value of the asset. So the first one is the PV of what you have, while the second one is what you have paid at or before the commencement date. And of course, if there is any initial direct costs you had, which we call directly attributable cost, if there is any dismantling and restoration cost, you also had. Of course, dismantling and restoration costs, according to IAS 16, you will need to get the present value of that as well. At the end of the year, you would measure this right of use assets using cost model of IAS 16. Using cost model, which is the cost minus accumulated depreciation and impairment losses. However, you can use revaluation model if that is how that asset is measured. If it is measured under revaluation model. You can also use fair value model under IAS 40 if that is how that asset is measured, especially if that asset is an investment property. You can use fair value model. So you're free to use whatever method you want to use. And that is it. Let's solve two questions. On 1st January 2002, Network Limited bought a plant from Password Limited under a lease contract. The terms of the lease requires Network to make 4 annual installments of 2 million each, payable at 31st December. The present value of the lease payment is 5.7 million. The interest rate implicit in the lease is 15%, and it is estimated that the plant will be economically productive for 5 years. There is an opportunity to extend the lease term at conditions favorable to Networks. The reporting date of Networks is December. Show the financial statement extract of Networks over the relevant period. Okay, this is common for you guys. They will ask you to show the financial statement extract. What that means is that you should prepare financial statements. So whatever way you are going to get those figures that you would ultimately present in the financial statement would show in your workings. But make sure you show financial statement. So from here now, net worth is the lessee and Password is the lessor. Okay, because Network bought from Password under a lease contract. The terms requires that Network make 4 annual payments of 2 million each, and it is payable at the end of each year, which is 31st December. They gave us the present value of the lease payments to be 5.7 million. Okay. So these ones have made it easy for us. They said the interest rate implicit in the lease is 15%. So it is estimated that the plant will be economically productive for 5 years. We're now told that there's an opportunity to extend the lease term at conditions favorable to Network. It can extend, and they say it's favorable. That means the lease term is not 4 years. That means the lease term is 5 years. And it's important you get this right, because if you don't get this right, you would make mistake when you are doing your depreciation, because the right of use asset is usually depreciated over the lease term. Over the lease term. So since the lease term now is 5 years, because they told us that there's an opportunity to extend the lease term at conditions favorable to Network. That means Network extend. Since it is favorable for it to extend. And of course, since the lease term is 4 years, it cannot extend beyond the useful life of the assets. That is why that extension is staying at 5 years. So that's why I'm saying that 5 years is the lease term now, since it can extend. So the reporting date for Network is 31st December. We are now required to show financial statement extracts of Network. Okay, so now let's start with our lease liability. You see, at the beginning, they already gave me the PV of lease rental to be 5.7 million, which is the beginning of 2002. Then at the end of the year, I will increase this with interest, 15%, which is 15% of 5.7 million. That will be 855. If I add those two together, it gives me 6.555 million. Then the lease payment, which is 2 million per annum, I'm going to remove this. If I remove this from this 6.5, it brings it down to 4.5. So at the end of 2002, I'm owing 4.5 million. See, I need you to note something in this 2002. We added the interest before we came to deduct the lease rental. Please remember to do that, particularly where the lease rental is paid at the end of the year. You add the interest before you deduct the lease rental. If you switch it, it won't give you the same result. It won't. And you would have to switch it if this lease rental was paid at the beginning of each year. In this question, it was paid at the end of the year. So this our approach is right. If the examiner told us that the lease rental is paid at the beginning of each year, believe me, it's the lease rental we will deduct before we come and add the interest. But we'll get there. So now, this 4.555, which is our liability at the end of year 1, we'll carry it to year 2, which is 2003. And on that amount, we're going to add 15% interest. If you punch your calculator and do 15% of 455, you get 683,250. If you add that to 4,555, you get 238. You then remove these payments as well. It brings it down to 3.238. We carry this forward again, of course, which is the 3,238. You apply the 15% on that 3,238, which is 485. If you add it together, it's 3,723. You remove the lease rental, 1,723, which you carry to 2005. You apply the 15% also, which is 258, which brings it back to 1982. You remove the 2 million, it gives you minus 414. This should be 0. There's an approximation error somewhere, but that is not particularly important for now. Okay, so Blessing, you want to ask a question?
Yes, I have a question, please.
Okay.
Please, could you please explain what you said concerning the interests, adding the interest before the lease payments once again at the end of the year?
Okay, so I made that very important point, right? Which I want you to note, that interest was added to this 5.7. In fact, interest was added before we deducted the lease payment, because the lease payment is made at the end of the year. That's where interest is added. Even though this interest and lease payments, as far as this two is concerned, interest is mostly at the end of the year. Interest is always at the end of the year. You're always unwinding the discount at the end of the year. So when lease rentals is not happening at the end of the year, so add the interest before you deduct the lease rentals. Interest to come first. Because at the end of the year, you need to know, okay, how much is my liability position? So that's why we need to add this interest. Then we know that, okay, 6.5. Then from there, you pay your lease rental. But if this lease rental is paid at the beginning of the year, so that means the lease rental should come first. Deduct lease rental before you come and add interest. Since interest happens at the end of the year always. So since lease rental is happening first, so deduct it first from your liability before you add the interest. I will solve a question. That's the next question I will solve. That will show you how that is done. Okay.
Thank you.
Yeah. So this is how we get lease liability. So now in 2002, now our liability at the end of the year will be 4.5 million. In 2003, our liability will be 3.2 million. In 2004, our liability is 1.7 million. And in 2005, it should be 0. This one should be 0. So I'll just assume that that amount does not exist. So let's go to right of use assets. Don't forget, the right of use asset is initially measured at the same amount the liability is initially measured, which is the present value of the unpaid lease rental. From this question is 5.7 million. In this question, we don't have any amount paid at the commencement date. We don't have any initial direct cost. We don't have any decommissioning cost. So the total right of use asset here is 5.7 million. And since we have agreed that the lease term is 5 years, since you can extend, that means the right of use asset is going to be depreciated over the lease term, which is now 5 years. Okay, that's why I said since there's an opportunity to extend the lease at a favorable condition. So the depreciation per annum is going to be 5.7 million divided by 5 years, which is 1.1 million, 1,140,000. So in my P&L now, what will go to my P&L for each year? The lease interest is going to P&L. This lease interest here, this interest here. Don't forget, I told you the double entry for this interest is to debit P&L and credit the lease liability. So it's coming to P&L here. It's coming to P&L for each year. The amounts we computed up there for each year. And as well as the depreciation also, which is this amount we got per annum every year for the 5 years period, 2002 to 2006. In the statement of financial position, firstly, my non-current asset, I have my right of use assets. The cost of the asset is 5.7 million or 2. Then my accumulated depreciation that will be accumulating. So in year 1, it was 1140. In year 2, it will be 1140 times 2. In year 3 times 3. In year 4 times 4. In year 5 times 5, like that, until the carrying amount becomes 0. Okay. Jacob, you want to ask a question? Go ahead, please.
So, for the statement of profit or loss, are we not going to add the 2 million that was being paid every year?
Okay, good question. So when I was explaining lease liability, I asked you what's the double entry for that lease payment, because we were told that we are going to reduce the liability with lease payments. I asked you what's the double entry, and somebody told me you credit bank and you debit the lease liability. So there's nothing about that 2 million that is going to P&L. It has nothing to do with P&L. You credit bank, you debit the lease liability. That is what happens. So that lease rental. So don't see it as rent that you put to P&L. See it as a reduction in our liability. Don't forget that we have already acknowledged the fact that the entire amount we want to pay for the entire period, we are owing it today. So as you are paying it every year, is actually reducing your liability. You credit bank, you debit the liability. You credit bank, you debit the liability. What goes to P&L is the interest and depreciation. Is the interest and depreciation. So it's always a huge fight in practice. It's always a huge fight because when tax people come, so tax people will disallow the depreciation. In fact, they would pick the lease rental, lease interest, and say they want to disallow it. That is fictitious. And unfortunately, rent that you're actually paying is not in P&L. It's not showing in your P&L. So that means you now suffer nothing. That means you enjoy nothing. And in the capital allowance table, there is no room for leased assets. So which rate do you want to use now? Which rate? So, I mean, it's always a huge fight, but I mean, we have found a way to resolve that issue in practice. But that's the accounting, which is our focus for this class, how we account and report for these items. So the lease payments doesn't go to P&L at all. You credit bank, you debit the liability. That's what you do. Okay, so I've explained the asset side, so which is just like deducting your accumulated depreciation from the cost. Then the liability side, which is the lease liability. So now I can see we have current and non-current, 1.3 and 3.2 for 2002. Is there anybody that can tell me how we got this 1.3 and this 3.2? Is there anybody that can tell us how we got this 1.3 and 3.2? Anybody?
We check the lease liability schedule for 2002. The balance carry forward is 4.5. 2003, 3.2. The difference, the reduction was settled within the next 12 months. So that becomes the current liability. Then if we deduct it from the 4.5, that balance becomes the non-current. So the current is 4.55 minus 3.2 gives us the current liability. Then the balance, when we discount that from 4.5, becomes the non-current.
That's absolutely correct. That's absolutely correct. Absolutely. See, this 4.5, as he has rightly explained, is our lease liability at the end of this year. But this lease liability, you agree with me that there's a portion of it that is payable next year. So the easiest way for you to get the portion that is payable next year, because a portion that is payable next year is current. Is current. So a lot of people will just go and put this 4.5 as non-current. You are wrong. You don't do that for leases. When we can easily know how much we are paying next year, you need to separate this 4.5 into current, non-current. Because there's a portion that is payable next year. There's a portion that will be paid after more than 1 year. When you can do that split, you split it. If you don't, the examiner will mark you bad. And that is what Ruben is explaining. Out of this 4.5, a portion is payable next year. And how do you get that portion? Since we already have this table, and I can see that at the end of 2003, what I'm owing would have reduced to 3.2. The only explanation or logical explanation to that, for our liability to have reduced from 4.5 to 3.2, is that we have settled the difference. If you punch your calculator for the difference, that's 1.3. That 1.3 that will be settled within 1 year is current. And of course, it's either you just take this 3.2 to be the non-current, which is the difference between 4.5 and what will be settled next year. The same thing in 2003. This 3.2 you are seeing here is also, you need to also split it, because there's a portion that is payable in 2004 and there's a portion that is payable after 2004. The portion that is payable next year is current. And the only logical way to determine that is 3.2 minus 1.7. Because for our liability to reduce from 3.2 to 1.7, it means we have settled the difference. So in 2003, that difference you settle next year is current. Then the balance is non-current, which is 1.7. In 2004, this 1.7, we expect that we should settle entirety of it next year. So this 1.7 will be current. And that's what we did under the liability side, separating the liability into current and non-current. For the current, lease liability is 1.3, non-current liability 3.2. As I've explained, this 1.3 is the one you are going to settle next year, and this 3.2 is the balance. In 2003, this 1.5 is the one you are going to settle next year, This 1.7 is the balance. And in 2004, you are entirely going to settle this entire 1.7 next year. So it comes in as current. And non-current is 0. And that is it for this question. Let's solve another question. It says a company enters into a 4-year lease commencing on 4th January 2001 and intends to use the assets for 4 years. The term are 4 payments of 50,000 commencing on 1st January 2001 and annually thereafter. The interest rate implicit in the lease is 7.5%, and the present value of lease payment not paid at 1st January 2001 discounted at that rate is 130,000. Legal costs to set up the lease incurred by the company were 402. Required. Show the lease liability from 1st January 2001 to 31st December 2004 and explain the treatment of the right of use assets. Again, almost similar question. The only difference is this. This company enters into a 4-year lease commencing on 1st January 2001 and intends to use the asset for 4 years. So you'll be paying 50,000 and you will start paying from the beginning of the year and annually thereafter. So the only difference between this question and the one we have solved earlier is here now we are paying at the beginning of every year. This 50,000 will be paid at the beginning of every year. That's the only difference. And of course, they gave us the present value of the unpaid lease rental. So they want us to determine the lease liability. So the lease liability at the beginning is 130,026. 130,026, which is this one. Lease payment is coming first, like I've explained earlier on. And that's because we are paying at the beginning of each year. But in the first year, it's going to be 0 because I cannot reduce it in the first year. And that's because this 130,000, okay, they have already reduced or removed that first 50,000. You see, it's a 4 annual payment of 50,000. But since the first one was paid at the beginning of the year, so in determining our lease liability, remember, is the present value of unpaid lease rental. So since we after of the 450,000 want to pay for 4 years, we have paid one already. So they just did discounting for the remaining 3. So at the first year, they have already deducted the 50 already. So it's not even included in this 130. So that's why this is 0 here. So the interest then comes next. So 7.5% of 130,026. So you add it to this, you get 139, which you carry forward to next year. So in the next year now, we can then deduct the 50. It brings it down to 89. If you add your 7.5 of that 89, it gives you 6.7. If you add that to 89, it gives you 96,511, which you carry forward to next year. If you deduct your 50,000, it brings it to 46,511. You apply 7.5%, 3,488. You add it to 46,511, it gives you 50, which you carry to next year. You then do your final payment, then it becomes 0. Okay, so so that is that. So Blessing, you want to ask a question?
Yes,
Can I ask?
please.
Go ahead,
sorry. Could you please explain how you got the 130,026?
They gave us in a question.
If the 4 payments is 50,000 times 4 is meant to be 200, then to be paid on how many installments? I think 4 installments. So I don't know. Okay. It's given, but are we not meant to have calculated it using the 50,000 naira commencing payments to get
Okay.
it for the 4
If you
installments?
insist, a good financial reporting question should not ask you to calculate this 130,026, but if they ask you, like I mentioned, is the present value of the annual payment. So since the unpaid lease rental is 50,000 for 3 years, we had already paid 50,000 at the beginning. So it's supposed to be 4 payments of 50,000. Since we have paid at the commencement date, remaining 3 that is unpaid. So they have given us the discount rate. You just need you use your annuity factor formula. By the time you multiply the 50,000 multiplied by your annuity factor, which is 1 minus 1 plus R, which is 7.5%, 1 plus R raised to power
4
raised to
minus
power
4.
minus 3 now,
3.
minus 3, then you divide by R, which is
7.5.
yeah, which will give us 7.
2.6.
Sorry?
To give us 2.6.
It gives us 2.6.
0.6. 2.6005.
Okay, if you multiply it by 50,000,
50. Then you get the 130.
okay. So, but that if they don't give you, well, I would expect a good question at this level. They should not be testing all of this. They should focus more on the accounting part, which is our concern, not how to do discounting or annuity or whatever. That's not, they should go and test that one in SFM. So they'll
No,
just
sir,
give you.
no. Like, sorry to draw you back. Like, in getting this 130,026, peradventure that we're expected to, discount it to the present value. Wouldn't they be able to give us a question whereby we'll be asked to, discount to the present value before we now start working out the liability?
Which is what I've just explained to you now. So yeah, I've just explained that this is how you get it, the present value. So when I say that in most questions you'll find they will give it to you. So just to work on, and that was what I was saying. A good question should not be asking you how to determine present value. They assume you know how to do that. What they are concerned about is how do you then account for it? So knowing that that would be what your opening liability will be, and also your opening right of use asset would be. That's what we want to know. That with this amount, you're crediting your liability and you're going to debit your right of use assets. That is our concern in reporting. But I mean, you're right. ICANN is funny. They could decide to say they might not even give you. So if they don't, this is how you determine it. The annual payments times the annuity factor. So 1 minus 1 plus R raised to power minus N divided by R. Okay, if I may ask you, This 139,000 now, how do you split it between current and non-current? How much will be current and how much will be non-current? Anybody? So Blessing, tell us.
Okay. Should we deduct 139 from 89778? I'm not sure, right? To get the amount, the liability to be posted to the current liability, then this 96,511 will go to non-current liability.
Okay, you almost got it. I don't know why you said it should be 139,778 minus 96,511. That goes to current, and this 96,511 will go to non-current. Then you'll have splitted this 139 into current and non-current. But you were close anyway. So for the right of use assets, so first, you're going to have the same amount as you have as liability, which is the PV of unpaid lease rental, which is 130,026. Then the amount paid at the commencement date, which is 50,000. Then if there is any initial direct cost, which there was, which is 400, and you add everything together, it gives you the cost of the right of use asset. Okay? The unpaid amount, the amount that was paid at the commencement date, and the initial direct cost. And these we are going to depreciate over the lease term, which is 4 years. So by the time you do 184,280 divided by 4 years, it gives you 45,107. Is never more than this in the exam. They have asked it one or twice in your exams. So it's just know this. Then leases, I mean, at this stage that we have gotten to, you are fine. However, there's something we call optional exemption. That exemption from application of the full requirement of this standard in such a way that when you lease an item, you don't have to credit lease liability, debit right of use assets, and be doing that schedule that we did, reducing the liability by lease payments, increasing by interest, and all of that. You don't have to do that. That all you just need to do is just, when you lease an asset, just the rent you are paying, put it in P&L. The rent you are paying, let it go to P&L every year. The rent you are paying, let it go to P&L every year. And you don't have to bother about right of use assets, this, that we are doing. You don't have to bother yourself about that. The rent you are paying, P&L every year. So we are saying you can use that simplistic approach if the lease is a short-term lease, okay? That's a lease of less than 12 months, or the underlying asset is a low-value asset. The underlying asset is a low asset. Is a low-value asset. So low value is low value. Like probably like a tablet, a personal computer, office furniture, telephones. If you lease some of these items, you say it's low value, don't bother complying with this full requirement of this standard. Use just the rent you are paying, put it in P&L every year. And that's it. So that's what we call optional recognition exemptions.
Other than that, you would have to apply the full requirement as we have done here. So what we have left is lessor accounting, which is very similar to lessee. Operating leases, there's really nothing there. And another one that will take like almost 30 or 40 minutes of our time is this one, sales and lease back. It's good I have done IFRS 15, so it makes this one easy for you to understand. And then by the time I'm done with this, then we'll be done with IFRS 16. So ultimately, let's just leave what we have left to our next class. Then we'll do another 2 hours. Then we'll round up on IFRS 15. So October, the final month of class. Two things are particularly important for us, 2 or 3 that are very, very important that we have not done. Number 1 is ratio. I know that some of you will have done ratios in some other courses that you're offering, and you have done ratio over and over again. So I think the approach I will use for you, instead of going one line by line with those ratio again, I will most likely just use past questions to show you how to solve ratio questions in the exam. I think that would be helpful to us for ratio analysis. So we'll do ratio, and there is we'll probably use a class for ratio. So there is this one, disclosure of non-financial information. Disclosures of non-financial information is like 25% of your syllabus. Is actually 20%. Then there is another 5% relating to ethics. So after ratio, I would look at those ones. Last I didn't gain at all. It was not in your, of course, it won't be like that this diet. The whole of last diet was just accounting standards, which is okay. That's why we are spending a lot of our time. It won't be like that this diet. So you see a lot of these, of course, standards will be there. This one that they didn't ask at all last diet will definitely be there. So we're going to do that after ratio. Then when we are done with that, then we can then come back and look at some other standards that we have not done. Particularly IS 21, effect of changes in exchange rates. It's a very straightforward standard, and it's particularly important. So why I'm taking it as a priority is because of the way our exchange rate is in Nigeria now. It's important that you guys that will be qualifying knows how to deal with when you deal in foreign currency transactions. So when you have a foreign operations, you should know how you deal with them. So I think for IS 21, I will particularly focus on foreign currency transactions. Mr. Kazim will teach you about foreign operations under foreign subsidiary. So even though I would also teach you how to translate a foreign subsidiaries or a foreign branch like that, how to translate their individual accounts or items into the presentation currency of the parent. But it would, I think that's the focus there. And question 1 of last diet was around that, even though it wasn't really around that, like that. That question 1 is more of accounting standards. And we were testing your knowledge about several accounting standards and all of that. So I hope I will be able to revise that question 1 of last diet with you. It's particularly helpful because it also exposes you to treatment of like a revision for most of the accounting standard that we have treated in this class. So those 3 is our priority for now. We'll finish it, then to a large extent, we are on a good side. Then if we still have time, then we can then be picking something like maybe IFRS 8 operating segments, which is a very short standard. Then maybe IAS 34 interim financial reporting, which is also a very short standard. So we can do those 2 in a day, 1 hour class. It won't take so much of our time, except if we just want to waste and just play around here. So they are very straightforward questions. So it's really coming over. We're very close to the end of the class, even though every of our class is very important, and I just don't want to just be teaching. I want to keep my classes short in a way that you will have followed from the beginning to the end, because the exam is not that straightforward. It needs you to understand these things very well, because they will come up with a lot of issues, a lot of scenarios that you might not have seen before. So it is now left to you and your deep understanding of these things. It's not the quantity of whatever it is, it's about the quality of the few ones you know. You have to know them very well. I'll be very glad that all of these things I'm teaching you, all of these notes you have in front of you, know them very well, like very well. That's what you will see in the exam. They will come out. So, but by the time you want to cover, I want to cover 100%, I want to do all of this, and you're reading outside of what we are teaching you in class, it will be a challenge, because that surface reading you will not cannot make you pass FR. I say FR, CR, with the way I kind of started asking these questions down, deep, and very well. Okay, so I mean, this is the time you have to start revising. 4 weeks to go. That is what it is. Me and you guys together, we have just 4 classes to go. Maybe 5. Let's say 5. You have just 5 classes to go. So the other 2 other weeks is what you have for yourself. So guys, let's make it worth the while. So I'll leave you for tonight. Go and read. You have a lot. I mean, if I should check, this is page 112 now. Everything before this page you have covered. Some that are after this page, I've even done. Like, I'm sure I've taught you IFRS 15. So you have a lot to really study. Okay, so I wish you guys the best of luck. I'll see you in class same time next week. Have a wonderful night. Good night.